Please come to the next paragraph. Paragraph 25. Net interest on the net defined benefit liability or asset. We will calculate interest on two items. We will calculate interest on obligation and will calculate interest on plan asset. Okay, first point. Second, both will be calculated at the same rate. Both will be calculated at the same rate. And then the net amount will be shown as finance cost in the profit and loss account. How it is calculated? Very simple. Multiply discount rate to the opening balance of net defined benefit liability or asset and adjust the interest for contribution and payment made during the period. For example, solve this example. Opening balance of net defined liability or asset is rupees 10 lakh. So this is 10 lakh is asset minus liability minus asset. 10 lakh is liability minus asset 10 lakh. Discount rate is 8% and the two contribution of rupees 1 lakh each was made on 30th September and 31st December of year, and two payments of rupees 2 lakh on 30th June and rupees 1 lakh on 31st March was made. So what you have to do, you have to calculate the net interest. Now see, your opening balance is 10 lakh. Two contribution of 1 lakh each was made. So on the contribution made, you will earn the interest or pay the interest? Hello? Contribution made, you will earn the interest. And on the payment made, you will incur the interest. My opening balance is liability. So first you calculate on opening balance the interest. Then you deduct the interest earned on these two contribution. Then you add the interest on these two payments that you have made. So understand, my opening balance is a liability, so I will have opening interest expense on opening balance 10 lakh into 8% minus, now if I am making contribution in the plan asset, it means my plan asset will go up. I will earn interest. This is expense, this is income, therefore minus sign. So on 1 lakh at 8% for how many months? 6 months. Sir, why 6 months? From 30th September till 31st March is 6 months. And then again one more interest paid, more contribution made on 31st December. 31st December to 31st March. Again 3 months. Yes or no? And then two payments were made. If you make the payment, your asset balance will come down. So add interest on 2 lakh at 8% from 30th June to 31st March. How many months? 9 months. Then the student is asking, why are you not calculating interest on this 1 lakh payment made? But that payment was made on 31st March. So time period is 0. So calculate the amount. Let me see who will give me the correct answer. Haji, calculate. Anybody wants to volunteer an answer? Why your response rate is so slow? 80? 8 lakh? Are you in your normal senses? 10 lakh into 8% is 80,000. 86,000. Okay, 86,000. So those who are weak in mathematics, write 86,000. Those who are saying 8 lakh, need to change your calculator. Okay, it is too old now. Now come to next paragraph. What is the presentation of interest in the financial statement? The net interest that we calculated will be shown in P&L account as finance cost, right? The interest income, underline this sentence below, the interest income determined as above will be recognized in P&L account and will be reduced from the return on plan asset, which will be recognized in OCI. In OCI, we show 3 items. Which 3 items? One is actuarial gain and loss, return on plan asset, except the interest shown as income in the P&L account, and the third was the effect of asset selling. Now, dear student, come to next part, presentation. There is no requirement to distinguish current and non-current portion of the asset and liability arising from post-employment benefit plan. So where do we present this liability arising from post-employment benefit plan? In non-current asset or non-current liabilities. Now we will just summarize where will you present the various item arising under post-employment benefit plan. For example, current service cost. Current service cost will be shown in profit or loss account as employee benefit expense. Interest cost on obligation. Interest cost on obligation and interest on plan asset and interest on plan asset, that is net interest, will be shown as finance cost. Will be shown in P&L account under which head? Finance cost. The interest will be shown as finance cost. It will be not shown as employee benefit expense. So the classification will be finance cost. Past service cost, vested and unvested, will be shown in employee benefit expense in P&L account. Under which heading? Employee benefit expense. Actuarial gains and losses and other remeasurement items will be shown in OCI. Okay. Now time has come to solve few questions which will give you a complete idea which number will be shown where, etc. So we'll take 2-3 questions. Fair value of plan asset on 1/1/2019 is 21,000. Fair value of plan asset on 31/12/2019 is 22,380. Defined benefit obligation on 1st January 19 based on actuarial valuation is 22,500. Defined benefit obligation on 31st December 2019 again based on actuarial valuation is 26,115. Contribution for the period 1575. Benefits paid during the year 1500. Current service cost 800. Discount rate is 8%. Prepare extract of SOFP and the SOPL and other comprehensive income after accounting for the defined benefit obligation. Done. Now let us understand the effect. These two are opening balances. First and third item, and the second and fourth item are closing balance. What is the treatment of contribution for the period? Plan asset account debit to bank. So this we will add in the plan asset. What is the treatment for benefit paid during the year? This will have two effects. Benefit paid will reduce my liability also and reduce my plan asset also. So the effect is defined benefit obligation account debit to plan asset. Effect. Current service cost entry. Current service cost account debit to defined benefit obligation. Okay. After that, we will see what is the carrying amount and what is the closing balance. The difference we will call as actuarial gains and losses. So first we will calculate actuarial gains and losses on plan asset. So check plan asset there. You can either prepare a ledger account or you can just prepare the statement. Both are welcome. Fair value of plan asset, opening balance 21,000. Then we will add the interest on opening balance, 6% of 21,000. 6% of 21,000 is 1260. And then we'll add the contribution for the period, 1575. Benefit paid, 1500. The total fair value of plan asset will be 22,335. This we will compare with the closing fair value of plan asset given in the problem, which was 22,380. Is it right? Now you tell me whether this is a gain or a loss item. Book value 22,335. Fair value 22,380. Is this 45 difference? The student has to answer, is it a actuarial gain or loss? Gain. You gain. All votes go for gain. Your answer is right. Value of asset is more than book value. So 45 is actuarial gain on plan asset. Now try this defined benefit obligation. Now come to the opening balance first. 22,500 tick mark. On opening balance also calculate the interest at 6%. 22,500 into 6%. Is it 1350? Yes. Current service cost 800. Add. Benefit paid reduce. Benefit paid reduce 1500. So now this will give me the carrying amount of the defined benefit obligation in the book. 23,150. And then defined benefit obligation on 31st December 2019 based on actuarial valuation is 26,115. So my difference is 2965. 2965. 2965. Is it a gain or loss? Why? Liability has increased. So what is my net remeasurement impact? 2920. Now I will show you how to present statement of profit and loss and OCI. So you will write in the profit and loss, finance cost, net interest cost, 1260 is on asset and 1350 is on liability. So that difference is 90 cost. Correct? Say yes. Yes. Employee benefit expense, current service cost 800 will come here. And in OCI, remeasurement loss on net obligation, 2965 minus 45, 2920. And how will you present in SOFP? In equity and liability, other component of equity, in other equity, remeasurement on defined benefit obligation will appear 2920. And net current liability, non-current liability, net defined benefit obligation you will show, which is the difference between closing defined benefit obligation, liability 26,115 and plan asset 22,380. So the net amount is 3735. You try one more question. Similar one. The following information relates to a defined benefit plan of Crown Limited. Is it there in your book? Where? Two zero? Okay. The plan asset on 1st January 2019, question 20, 1,42,000 500. And then defined benefit obligation is 1,50,000. Current service cost 13,500 discounted 6%. Expected return on plan asset. Expected return on plan asset. Okay, now I was reading this line. Expected return on plan asset on 1st January 2019, 10,000. Remeasurement loss arising in 2019, 2,250. Past service cost arising on 1st January 2019 is 4,500. And then vesting period for past service cost. Is it relevant? Vesting period for past service cost? That is not relevant. Is 5 years. So now the question is, compute the amount to be presented in the statement of profit or loss and other comprehensive income. So check the answer. Which amount will be presented in OCI? P&L account and OCI. Keep the question in front of you. Current service cost will come in the profit and loss. Tick mark, current service cost. Then net interest cost will come in the profit and loss. Net interest will be the 6% on obligation minus 6% on plan asset. So just check the calculation. Is it 450? Say yes. Yes, tick mark. Then past service cost will come. How much is past service cost? 4,500 full amount. Even if the vesting period is 5 years, that line is not relevant. And what about that expected return on plan asset? That will not come. Only the interest on plan asset will come in P&L account. The effect of all this has gone into remeasurement recognized in OCI. So this remeasurement takes into account the actuarial gains and losses, 2,250. So therefore the net cost for the year recognized in total comprehensive income 20,700. Okay. Now we'll just revise how to reconcile liability. This is a good table for you in case in the exam any balancing figure is there. It will be somewhere in this only. Okay. Like the previous two problem we solved. And this is a disclosure requirement also at the end. The companies have to present reconciliation of defined benefit obligation like this. Is it printed in your book? No. Would you like to write down or just understand? You want to write down? Okay, then write down in your notebook, write down, not in the corner of the pages. Write properly. Bring a good notebook. So first let us understand reconciliation and then we'll solve a case study also. Okay. A small case study on defined benefit plan. So reconciliation of liability will be presented like this in your notes, and this is useful for you also in the exam. You will have first present value of obligation as at the beginning. You can write opening balance. Then you will add current service cost. Add current service cost. Add interest cost. Interest expense. Here interest expense will be only on the obligation, not on the asset. Asset will be shown in second chart. And then D, remeasurement. Remeasurement into bracket or actuarial gain or loss. or actuarial gain or loss, oblique loss arising from change in demographic assumptions, change in demographic assumptions, change in financial assumptions, change in demographic assumptions, change in financial assumptions, experience variance, experience variance means difference between actual experience versus assumption. These two are change in assumption, and this is what actually happened versus assumption. And then E, past service cost, past service cost, F, benefits paid, benefits paid. Past service cost oblique curtailment also you can write, oblique curtailment. Yesterday we had passed one entry in curtailment. Benefits paid, therefore present value of obligation as at the end. So normally in the exam the balancing figure you have to find would be the actuarial gain or loss. Current service cost you know how to calculate. Yesterday you have learned the liability chart. Interest expense you have learned how to calculate. And this benefit paid will be given to you, past service cost would be given to you. Closing balance of liability will be given to you. Then you can find the actuarial gain or loss. And then there is another disclosure requirement is reconciliation of asset. So reconciliation of asset, plan asset, reconciliation of plan asset. So write down point number A, fair value of plan asset as at the beginning. Fair value of plan asset as at the beginning. Fair value of plan assets as at the beginning. Point B, write down investment income. Investment income. In bracket write calculated at the discount rate. Calculated at the discount rate. That means the discount rate multiplied by this fair value of plan asset. Then you will write add contributions. Add contribution. Then write benefits paid, less benefit paid. Less benefit paid. And then write return on plan asset. Return on plan assets. Excluding amount recognized in net interest expense. So this amount is the return on plan asset minus this investment income. Yes, this goes into that OCI. So OCI plus this is the total return on plan asset. And therefore write down fair value of plan asset as at the end. Therefore fair value of plan asset as at the end. So these are the disclosure, and you have to also disclose actual investment income. Yes, total A, B plus E. Okay, now you are ready to solve, but before that you can also write the presentation in P&L account. In the P&L account, write down the following items are shown in P&L account: current service cost, past service cost, oblique curtailment and settlement, oblique curtailment, oblique settlement, past service cost, curtailment, settlement, and then net interest income or cost. Net interest income or cost. Net interest income, because on one hand you are incurring expense also, but at the same time using that money which you have invested, you are earning income also. So therefore net interest income or expense. And then expense recognized in income statement. Now write down expense recognized through OCI. Expense recognized through OCI. So what are the presentation requirement in OCI? Expense recognized through OCI. A, write down remeasurement cost or actuarial gain and loss. Remeasurement cost or actuarial gain or loss. Under that, it will be divided into 3 categories: change in demographic assumption, change in financial assumption, and experience variance. Is it right? Point B, write down return on plan asset. Return on plan asset excluding amount recognized in net interest expense. Excluding amount recognized in net interest expense. Point C, write down remeasurement arising because of change in effect of asset ceiling. Because of change in effect on asset ceiling. Because of change in effect of asset ceiling. Okay, and this will give you total remeasurement cost recognized in OCI. What is pending now? Case study. A small case study. This will require you to prepare, for example, all the 4 statements now. Is it right? And after reading the case study, you just have to put the numbers in these 4 statements. So first we will read, and then we will tick mark which item will be shown where. AB Limited is a private limited company, and it has established a post-employment funded defined benefit plan for its employees. In accordance with the terms of the plan, the employees will receive a pension equal to 2% of the final year salary of employee, multiple of year of service with the entity. AB Limited determines the cost of the year using PUC method, which also takes into account some actuarial assumptions regarding the employee turnover, mortality rate, inflation rate, discount rate, which are based on the rate of return on high quality corporate bond. So what is the use of first paragraph? No use for accounting purpose. It's only a defined benefit plan that you have understood. Following is the information relating to defined benefit plan for the year ended 31st December 2010. The present value of the pension benefit in respect of employee service for the year ended 31st December 2010 is $80,000. Now, where will this item appear? It will appear in statement of financial position. The present value of pension benefit in respect of employee service for 31st December. Okay. In respect of employee services for the year ended. So this is current service cost. This is the current service cost, or just let us read further. AB Limited paid pension benefit of 84,000 to former employees in the current year. Entity has contributed $40,000 into plan asset. In the year end, the present value of defined benefit liability was, now this is the balance sheet figure, was $6 million at the year ended 31st December 9 and 6.7 million at 31st December 2010. Similarly, they have given fair value plan asset was 5.8 million on 31st December 2009 and the fair value of the plan asset was 6.15 million on 31st December 2010. AB Limited had amended the plan on 31st December 2010 and as a result employees are now entitled to an increased pension benefit. The estimated present value of this benefit is $250,000 on 31st December 2010. So what will you call this 250,000? Can you call it as a past service cost? Can you call it as a past service cost? No. You have made an amendment in the plan which has resulted in increasing your liability by $250,000. So can I call it as a past service cost? Say yes. The interest rate on high quality corporate bond is 6% per annum. So this I will require for 6% of opening liability and 6% of opening plan asset. AB Limited recognizes remeasurement gain and losses in OCI, that is item that will not be reclassified to P&L account in accordance with IAS 19 revised in 2011. Required prepare the extract of financial statement in respect of defined benefit plan of AB Limited for the year ended 31st December 2010 along with movement in defined benefit liability and plan asset. Assume that the pension benefit and the contribution paid were settled on 31st December 2010. So no interest effect on this, right? Because these were settled on last day. If they are paid somewhere during the year, then there will be an interest implication of that also. Correct? Solve. Let us start. Tick mark the number in the right place. What is this item? Present value of pension benefit in respect of current year. Current service cost. So this you first tick mark in profit and loss. 80. Figures in 1000. Write down at the top figures in 1000. So 80 in current service cost, and you also tick mark in defined benefit liability. Step 3 second line 80. It will be added to liability also. Tick mark 2 places. Done. AB Limited paid pension benefit of 84,000 to former employees in current year. This you tick mark in liability 84 and also tick mark in benefit paid in plan asset 84. One single tick. At the end, We will check whether all items have been ticked marked or not. In the exam, you have to write the answer, okay? The entity has contributed an amount of 40,000 in plan asset. This you only tick mark in plan asset 40 plus. Present value of defined benefit liability was 6 million at the beginning and 6.7 at the end. Go to step 3, tick mark 6,000 opening, tick mark 6700 closing in the liability, and then in the asset step 4, tick mark opening 5.8 million 5800, tick mark closing 6150, single tick. And what we will do, using this opening balance, will also calculate the interest. So you come to statement of profit and loss, tick mark interest expense 6% of 6,360, P&L account step 1, tick mark interest expense 348, interest income 6% of 5800. Have you tick mark? And you also go to liability step 3, add interest 360, go to plan asset, add interest income 348. And now what is the next paragraph? This 2,50,000 is past service cost. Tick mark in P&L account, second line, past service cost 250. Tick mark in liability, add past service cost 250. The interest rate adjustment we have done. Then AB Limited recognizes remeasurement gain or loss in other comprehensive income. The problem was not as difficult as it seemed to be. Now we will have to first find out what is the actuarial gain or loss on defined benefit liability. You have written this item: opening balance, CSC, PSC, interest, benefit paid, closing 6700. So can you see in your own handwriting, you have not yet ticked mark this 94? 94 is your actuarial loss with respect to liability. Okay. And then try asset. 5800, 40, 348, benefit paid 84, remeasurement gain 46, balancing figure, closing is 6150. Okay, so 46 gain and 94 loss. So my other comprehensive income will show remeasurement loss on defined benefit liability 94, gain on plan asset 46, net effect is 48. Is it right? Tick mark. And then how your financial position, that is statement of financial position, look like: present value of defined benefit obligation at reporting date 6700 less fair value of plan asset on reporting date 6150, therefore net liability 550. Simple question. So this completes part 2, post employment benefit plan. Now part 3. What is part 3? Other long-term employee benefit, para 27. Example of other long-term employee benefit. So first of all, let us revise what is other long-term employee benefit. These are payable more than 12 months after the reporting date, but before the retirement. Now example: sabbatical leave, jubilee benefits. Jubilee benefit means if an employee completes say 15 years, 20 years, 30 years in an organization, then the organization gives them some kind of reward, cash or kind. Long-term disability benefit. Now what is the accounting treatment or accounting requirement of other long-term employee benefit plan? So you just have to remember, it is similar to post-employment benefit plan. Post-employment benefit plan. So it can also be defined contribution plan, or it can also be defined benefit plan. So it can be DCP or DBP, depending upon how that plan is agreed. Okay, then what is the difference? The difference is, however, when other long-term employee benefit plan is treated as a defined benefit plan, the remeasurement gain or loss. In case of other long-term employee benefit plan, the remeasurement gain or loss is shown in SOPL. Is shown in SOPL for other long-term employee benefit. Reason? I don't know. Because many times they have said you put this in this item, this in the other item. And many times, even though I try very hard to find the logic, they are not able to explain. Even in the institute module or the original text of IFRS, maybe because the reason may be such items are rare. It will not be much. And therefore you put it in the P&L account and close that account. This kind of scheme may not be as common as the post-employment benefit plan. That may be the reason, and therefore they don't want to unnecessarily carry it and show it in the other item in the OCI. This is what I tried to find out, and this is I understood, but then there can be some other reason also. In the earlier AS 15 also there was a difference between the treatment of deferred past service cost. And that time the institute had written in the standard that such items are very rare and not very significant also. So therefore the better would be in other long-term employee benefit plan, transfer deferred past service cost to P&L account. That is in AS 15. So they want to keep this plan a little simpler than the post-retirement benefit plan. Now the last part is termination benefit. Then the standard will be terminated. So what is termination benefit? Termination benefit means benefit payable due to which event? Termination, not rendering of service. Okay. So the event which give rise to the obligation is termination benefit. Termination of the service rather than rendering of the service. So this is a very unique feature. What about the accounting treatment? The accounting treatment is this will be treated as expense and a liability in respect of amount of termination benefits payable to settle the obligation in the year of termination. However, such plan can also be treated as post-retirement benefit plan. The termination benefit can be accounted like a post-retirement benefit plan if the benefit is paid over a period of time. If the benefit is paid immediately, it is treated like a short-term benefit plan. If the benefit is deferred more than 12 months from the balance sheet, then the discounting will be required. So accounting for this termination benefit plan, once again, if the benefits are payable within 12 months, short-term employee benefit, no discounting. Benefits are payable after 12 months, then discounting will be required. And sometimes this termination benefit is paid in the form of retirement benefit only. So that is, instead of paying a lump sum amount, they'll pay some amount over a period of time. So then this will get accounted as post-employment plan. When will termination benefit arise? When either the employer terminates the services or the employee accepts the voluntary retirement. It's not always voluntary. Employer may also terminate. Should we make provision for termination benefit? Suppose the payment is not made. The answer is yes, if following 4 conditions are satisfied. Example, following 4 conditions. Condition number 1, there is a present obligation. When will present obligation arise in case of termination benefit? When the employer and employee have agreed to the terms and condition of termination. Both parties have signed the agreement. It is arising as a result of past event, that is the services were rendered by the employee. And third is a reliable estimate can be made. Fourth, probable outflow of economic benefit. Does it remind you of requirement of provision under IAS 37? Yes. So you can simply say if all the requirement of provision are satisfied, then the entity will make a provision. Entry will be termination benefit expense account debit to provision for termination benefit. And then whenever you will pay them, accordingly do the future accounting. If it is payable within 12 months, you pay it and close that account. If it is payable more than 12 months, you have to do the discounting and account at present value. Which discount rate will be used? At certain places we have talked about discount rate. Discount rate in this standard will be the market yield of high quality corporate bond. Market yield of high quality corporate bond. What if the market yield on high quality corporate bond is not available for the desired maturity? Then they are saying in the absence of deep market for such bond, the market yield of government bond will be used for discounting. Now this is a difference between Ind AS and IFRS. That is the standard. Okay. Otherwise the two standards are more or less same. Last part of this wonderful standard, disclosure. Second last part. First is there is no specific disclosure requirement for short term, other long term and termination benefit. No specific disclosure. Voluntary, if you want to disclose something, then it can be given. But major disclosure requirement are with respect to post retirement benefit plan. Under that, first defined contribution plan. Defined contribution plan, you have to disclose separately amount recognized as expense for defined contribution plan in P&L account. Then defined contribution plan for key managerial personnel as per IAS 24. What is IAS 24? Oh, related party. That's good. And then for defined benefit plan, there is a long list of requirement. I will just read some of them. General description of the type of the plan. And then you have to disclose under that the nature of benefit provided by the plan, regulatory framework, like for example payment of gratuity act, in which the plan operates, and any other responsibility for the entity in governance of the plan. Next disclosure is net defined liability or asset, showing separately, this we have discussed just now, reconciliation between opening and closing balance of present value of obligation and fair value of plan asset. You have written in the notebook also that reconciliation. What would be included in the reconciliation? Between an opening and closing balances, following items may come: current service cost, interest income, interest expense, return on plan asset, actuarial gain or loss arising from demographic assumption, actuarial gain or loss arising from change in financial assumption, past service cost, gain and loss from settlement, any effect of change in foreign exchange rate. Change in foreign exchange rate in case of any calculation which is dependent on foreign exchange, like a liability which is to be settled to a foreign employee. Okay. Then the calculation will be based in dollar. I have an employee in USA right now, so we will pay him in dollar. But how do I account for it? Rupees. So in case of any such changes, disclose. Then contribution to the plan, payment from the plan, and again effect of any business combination and disposals. So this may also reduce your or increase your obligation. You may have to take the obligation of other entity, or you may have to transfer the obligation to other entity. So that is also to be shown in reconciliation. principal actuarial assumption, a sensitivity analysis for each significant actuarial assumption, showing how defined benefit obligation would have been affected, and method and assumption used in sensitivity analysis and changes from previous period. That means you have to also disclose in the notes if some variable changes, how it might affect your liability. Right? Few paragraphs read on your own. Now come directly to major changes. One major change is the use of discount rate in Ind AS 19 and your IAS 19. So what is the discount rate used in Ind AS 19? According to Ind AS 19, which is followed in India by some big companies, the rate to be used to discount post-employment benefit obligation shall be determined by a reference to market yield on government bond. Because India is a developing country, and here the market for high quality corporate bond is not matured. Only government bonds have matured. Second, the interest rate on government bond is low. Interest rate on corporate bond is very high. So that will make an impact on the present value of liability calculation. So if I use high quality corporate bond, then the liability in the initial year would be on a lower side. So to ensure that the liability is not reduced, it is on a higher side, take the discount rate on government bond. Government bond interest rate is lowest. Lower the discount rate, higher the present value. That is the logic they have used. And second, high quality corporate bond market is not very much matured in India. Most of the trading that takes place is in government bond. And then the subsidiary, associate, joint venture and branches domiciled outside India shall discount post-employment benefit obligation by reference to market yield on high quality corporate bond. They are allowed, those which are outside India. In case such subsidiary, associate, joint venture and branches are domiciled in countries where there is no deep market in such bond, the market yield on government bond of that country shall be used. So this is about Ind AS 19. So companies which are based out of India, in India, say for example, will follow market yield on government bond. But if their associate, subsidiary, joint venture are outside India, they are allowed to follow high quality corporate bond yield. If that is not available, government bond. IAS 19 only says the first priority will be given to high quality corporate bond. Go to government bond only if the high quality corporate bond of similar maturity is not available. In foreign country, the interest rate is in any case very low. Is it right? Maybe 4%, 5%. So therefore they don't bother much. But in India, the gap between the government bond yield and corporate bond yield is significant. It may be a gap of 4 to 5% also, 3 to 4% also, which is a huge difference. Second difference is example on gratuity. To illustrate treatment of gratuity subject to ceiling under Indian gratuity rules, an example has been added in Ind AS 19. Ind AS 19, okay. Do we have an example in IAS 19 also? No, IAS is global standard. Ind AS is specific to India, where there is a specific law called POGA, Payment of Gratuity Act. Over. This chapter is over.